Euro to Japanese yen forex chart shows a strong start to April prior to the current flattening of price, as seen with many balanced dojis and spinning tops. And within these narrow ranges, there are plenty of candles exhibiting lower and upper wick rejection. A large bearish star sees the next candle trade and close below it. However, it is a large bull hammer since it forms below the bearish star, and when they are combined, they essentially form one big doji, which is why the market continued to remain relatively flat for a few more days. Eventually, bearish sentiment develops for a clear downtrend that is slowed from time to time, especially with these large bull hammers, which certainly did put doubt into the longevity and strength of the developing downtrend. This points to the possibility the market is unable and/or unwilling to sustain a rapid drop for much longer. There is a recovery back up towards and over 132.5, and this level in particular does shed light as to why the market began to slow down in the past due to this being a major long-term resistance. It retained influence well into the future as the market fluctuated above and below it. The downswing point that begins 2014 on a downtrend is a less strict bearish star. When focusing on the downtrend that starts 2014, it is another slow start. This starts with the bearish star, which does have upper wick rejection, but it is a green candle, so slightly less bearish, and it does continue the existing uptrend slightly higher. It is also a less strict bearish star compared to theoretical diagrams, because the real body is around the lower half of the candle, as opposed to concentrating closer to the lower third of the candle. These features of the less strict bearish star contribute to the delay before the downtrend was accelerated, when the strong red candle closed well below the bearish star's low 4 days later. In sharp contrast, the following reversal candles also exhibit sharp upper wick rejection and lower wick rejection for upward reversals, and this is done with little to no delay, where the candles that precede the reversal candles go above the highs and below the lows respectively to quickly begin the new trend. As seen before, dojis emerge at flatter periods in the market, and this serves to cast doubt, especially near significant long-term levels, as to whether the market will immediately reverse or merely pause before a continuation of the existing trend. Upper wick rejection at upper ranges of resistance are a bearish sign, but the market is slow to move down from these significant ranges, despite the following candles quickly closing below the lows of these downswing points, largely because of the close proximity of the 143 to 140 range, which acts as a very close and significant support range. A line chart with dots representing the closing prices once again demonstrates the tendency for closing prices to cluster near major levels of significance. Despite the relative strength of 143 to 140 as a support range, they are breached, largely due to these two large red candles which spike through them and serve to accelerate the longer-term bearish context with this double top reversal that finally gets going at the beginning of 2015, where a likely downward continuation forms, where here there is a falling 3 methods forming. The fall continues and the 132.5 becomes relevant once again as it acts to slow down the rapid downtrend. It doesn't produce a full upswing, but it does serve to have the secondary characteristic of a support level in that it slows down a bearish trend. Later on, when the market recovers, the same levels become relevant once again, and they are only surpassed with strong green spikes. And towards the top here, there is another double top reversal showing upper wick rejection with these candles at the downswing points. The upswing in September is actually a harami with these two candles and certainly no bull hammer, but when these two candles are combined, they form a bull hammer, and the first red candle here does show lower wick rejection at the major 132.5 level, indicating that the market is unable and unwilling to go lower, and the bullish sentiment is coming back.